All right, let's jump right into a huge question that's on a lot of people's minds, one that sits right where old-school finance and the new world of crypto collide. What on earth is going to happen to Bitcoin if the Fed chair, Jerome Powell, resigns?
I know, it sounds like a paradox, right? Bitcoin was created to be outside the system. So why does its price seem so connected to what one guy in a suit in Washington, D.C. says or does? Well, that's exactly what we're going to unpack today.
But hey, before we get into the weeds, just the quick but really important disclaimer. This is all for informational purposes. It's definitely not financial advice. Everything we're talking about comes from stuff that's already out there in the public domain.
So first up, we have to understand something called the Powell effect. Seriously, when Jerome Powell speaks, the entire financial world holds its breath. His words can shift trillions of dollars in a heartbeat, and that absolutely includes riskier assets, like Bitcoin. Let's dig into why.
This quote from Mosaic Asset just nails it. The market's attention is completely fixated. We're talking about traders, big investment funds, even trading algorithms, all hanging on his every word. They're all trying to read the tea leaves to figure out where interest rates are headed next.
And that brings us to the big what if. You see, a new administration in the White House could mean a new face leading the Federal Reserve. And that new person might have a very different idea about interest rates. Maybe someone who wants to cut them to get the economy really humming.
And here are some of the names being floated. You've got guys like Kevin Hassett and Kevin Warsh, both known for wanting to lower rates. Even Christopher Waller, who's already at the Fed, has been on board with cuts before. The common thread here, they tend to favor a more accommodative policy, which is just a fancy way of saying they want to make money cheaper and easier for everyone to borrow.
Okay, so what does this mean for Bitcoin? Let's start with the sunny side of the street for crypto investors, the bull case. This is the idea of a massive liquidity flood.
The thinking goes something like this. People call it the money spigot theory. The Fed turns on the spigot by cutting interest rates. All of a sudden, it's way cheaper to borrow money. And those super safe investments like government bonds, they start paying out next to nothing. This pushes investors to go hunt for yield, meaning they start looking for better returns in riskier places, like the stock market, and you guessed it, crypto.
So the key takeaway here is pretty simple. When interest rates are low, speculative assets like Bitcoin start to look really good to investors who are chasing those higher returns. This is the exact narrative that's fueled some of the biggest crypto bull runs we've ever seen.
But, and this is a huge but, it's not all sunshine and rocket emojis. This whole thing is a double-edged sword. There's a pretty scary potential downside to all this easy money, and it's a big one. The risk that the Federal Reserve could lose its independence.
Now, central bank independence sounds kind of boring and academic, but it's the bedrock of a stable economy. It's this simple, powerful idea that the Fed should make decisions based on cold, hard economic data, not because of political pressure from whoever is in the White House.
And believe me, this isn't just theory. This quote from ING cuts right to the chase. The value of the dollar as a reserve currency fundamentally lies in Fed independence. Think about that. The trust that the entire world has in the US dollar is built on this very principle.
So, what are the real-world consequences? What actually happens when people start to think a central bank has lost its way and is just doing what politicians tell it to do?
Well, let's look at a pretty stark cautionary tale. After Turkey's well-respected central bank governor was fired back in 2021, the Turkish lira basically collapsed. It lost around 60% of its value against the dollar in just 2 years. That's a catastrophic meltdown that shows you exactly what happens when markets lose faith.
And this isn't some far-fetched fear. It's a concern that's being echoed by people who know this system from the inside. Joseph Wang, who actually used to work at the New York Fed's trading desk, has warned that the market is underestimating the risk. It's something that serious people are watching very, very closely.
Okay, so let's put it all together. What we have here are two incredibly powerful and totally opposite forces pushing against each other.
So here's the core conflict, laid out side by side. The bull case is all about that liquidity flood from lower rates pushing a wall of cash into Bitcoin. Simple enough. But the bear case is the terrifying counterpoint. What if that action ends up destroying the Fed's independence? That could destabilize the US dollar itself. And here's the kicker. Since most of the crypto world is still priced in dollars, a crisis for the dollar could easily become a crisis for Bitcoin. It's a classic battle. Short-term party versus long-term stability. And of course, the Fed chair is just one piece of a much, much bigger puzzle. You've got other huge things happening. We're seeing giant institutions pour money into Bitcoin ETFs.
More and more companies are putting Bitcoin on their balance sheets as a reserve asset. The whole regulatory scene could get a lot friendlier. And all of this is playing out against a wild backdrop of global politics and tensions. All these things have a ton of influence, no matter who's running the Fed.
So this leaves us with the million-dollar question. Or maybe it's the trillion-dollar question. What does the market really want? A flood of easy money right now that could juice asset prices? Or the stability of the entire financial system for the long haul? The answer to that question is probably going to shape the future for all of us.